In the world of economics, there's an old saying, there's no such thing as a free lunch. But for the last decade, index funds have been the closest thing to it. You buy the whole market, you sit back, and you let the relentless engine of U.S. capitalism do the heavy lifting for you. But as we enter 2026, the engine is sounding different, with interest rates finally stabilizing and the AI-fueled great divergence separating the winners from the losers. Buying everything might not be the safety net it used to be. Today, we aren't just looking at what worked in 2020. We're looking at the 3 specific index funds that are positioned to survive and thrive in the unique economic landscape of 2026. Now, I know what you're thinking. That's boring, and you're right. But in economics, boring is often synonymous with efficient. By 2026, the S&P 500 has evolved. It is no longer just a collection of 500 random companies. It is effectively a global tech industrial complex. Why 2026? Unlike 2023, where a few magnificent stocks carried the weight, 2026 is seeing a broader earnings recovery. With an expense ratio of just 0.03%, BOO remains the gold standard for American investors because it captured the massive scale of U.S. corporate resilience. If you bet against the S&P 500, you're essentially betting against the concept of corporate productivity itself. In a 2026 economy defined by efficiency gains, this is your baseline. Our second pick isn't just about what you own, but how you own it. Enter the Fidelity Zero Large Cap Index, or FNILX. This fund represents a fascinating economic shift, the commoditization of the index. Fidelity offers this with an expense ratio of exactly 0. No fees, nothing. Why would a multi-billion-dollar firm give you a product for free? Because in 2026, data and ecosystem loyalty are the new currencies. By holding FNILX, you aren't just investing. You're participating in a new era of financial services where the cost of entry has been obliterated. For the U.S. investor in 2026, where every basis point of inflation matters, saving that 0.03% to 0.10% on fees isn't just penny pinching. It's an optimized economic move. It tracks a proprietary Fidelity index that mirrors the S&P 500 almost perfectly, giving you the same exposure without the brand name tags. Finally, we have to talk about the future. If BOO is the bedrock, the Invesco NASDAQ 100 ETF QQQM is the skyscraper being built on top of it. You've likely heard of QQQ, the legendary NASDAQ tracker. But for 2026, we're looking at QQQM. It's the same underlying assets, but with a lower expense ratio designed for long-term buy and hold investors rather than day traders. The 2026 context. By now, the AI hype has matured into AI implementation. We're seeing which companies are actually using automation to boost their bottom lines. QQQM captures the 100 largest non-financial companies on the NASDAQ. In an era where the U.S. is aggressively reshoring semiconductor manufacturing and leading the world in software as a service, QQQM is your concentrated bet on American innovation. It's more volatile, yes, but in a 2026 landscape where growth is the only way to outpace aging demographics, this is the engine of the portfolio. Investing in 2026 isn't about finding the next moonshot crypto or a single lucky stock. It's about understanding the macro trends, fee compression, technological dominance, and the sheer scale of the U.S. market. by balancing the stability of VOO, the cost efficiency of FNILX, and the growth potential of QQQM. You aren't just buying stocks. You're positioning yourself on the right side of economic history. But remember, while the indices are passive, the world is active. Stay informed, stay diversified, and as always, thanks for watching.